Mark, I wonder what you think is going to be the next catalyst or the thing that consolidates your view around bonds, because I know they haven't moved in the way you'd expected over recent weeks. So is it going to be revisions to job data today, inflation data, the Fed decision next week? When do we anticipate a little more clarity?
Good morning, Anna. You're always so polite, but let's say it clearly. I have had bonds entirely wrong over the past month. My central premise of the past month was that US yields would go higher and that would make it more problematic for stocks. And instead, Treasury yields have come lower. I kind of only conceded that I was wrong on that belatedly on Friday's jobs data out of the US. So with that kind of premise, that it is the disclaimer that I've had the narrative wrong in bonds over the past month, I do think that if anything, there's probably a little bit more yields downside of anything. Yes, we have the revisions today, but I don't think that's the big catalyst. I think until the Fed, I think it's going to be hard for yields to rise much. We'll reassess the narrative then. That means that the backdrop for stocks generally is relatively supportive, but I think it's going to stay very choppy. And I continue to have high conviction in US stocks underperformance, which is a theme which has started to regain momentum again. Even though US stocks are on record, they're trailing global stocks. And that's partially because we're seeing dollar depreciation again. People are re-engaging with that story. And I think the reason I've renewed conviction in US stocks underperformance is I think the AI trade is continuing to be difficult into year end.
OK, that kind of takes me perfectly to my question, Mark. There appear to be two known risks at the moment, one of which is an economic slowdown in the United States, a recession. The other one is a re-rating of AI. Those appear to be the two known risks. What am I missing? Is that it? Is that what all the market needs to worry about right now? Or is there something else, a third rail, that the market needs to worry about that we're missing right now?
So I think the AI one is a valid one, but it's just impossible to time. But it's a big risk out there. It's a threat overhanging the market, but it could still be months away. I think a recession is very hard when the government's pumping so much in, and we haven't seen the private sector collapse precisely because of the spending in AI. So I think it's unlikely we're going to have a technical recession. I think what I'm more worried is a bit more of a stagflationary dynamic, and probably the extra one that you're missing there is I do still think the market is underestimating how much inflation can take off again. I think that's going to be a real narrative over the coming year. Now, the reason I'm kind of not pressing it too hard right now is, first of all, I've been wrong on yields rising over the past month. But second of all, I think it's going to take time for that to feed through. And it's not going to we're not going to suddenly trade that narrative on the PPI and CPI prints this week. It's been very clear that unless they're completely shocking, the Fed will cut by at least 25 basis points at this coming meeting. And I think 50 basis points is potentially in play. I don't think it's going to the route they're going to choose, but I think people will bet on that. So I think this won't be the time we'll trade that inflation narrative. But that's the other big risk out there, that we've got inflation. And if it's inflation coming as slowing growth, it's very problematic. And that's why I think the backdrop for equities into year end will be difficult and choppy, but bullish for global stocks, not US stocks as much.